In 2015, Bitcoin bottomed and went on to rally by 10,000%. That move lasted exactly 36 months before Bitcoin topped and entered a 12-month bear market, falling by 85%. In 2018, Bitcoin formed another major bottom and surged by 2,000% in precisely 36 months. Right after, Bitcoin peaked and went into a 12-month bear market, declining by 80%. Once again, in 2022, Bitcoin bottomed and climbed by 700% over the following 36 months. But that window officially came to an end in October of 2025, the very month that marked the highest price of this bull run. Since then, Bitcoin has fallen by 35%, tracking a similar timeline to the previous two cycles. This repeating pattern is what's commonly referred to as Bitcoin's 4-year cycle, and mainstream media has been quick to declare that the cycle is repeating once again. Indeed, at first glance, the data appears to support that view. The total supply of Bitcoin currently in loss has surged to its highest level in 2 years. The last 3 times we saw this, Bitcoin was transitioning into a bear market, with further downside to come. If Bitcoin were to follow the same path as prior 4-year cycles, that would point to prices potentially revisiting the 30,000 region by late 2026. But before drawing that conclusion, we need to examine what actually drives these 4-year cycles in the first place. That force is something known as the business cycle. The business cycle is the recurring pattern of economic expansion and contraction over time. This is not about predicting exact dates, but about evaluating whether economic conditions are improving or deteriorating. There are 4 phases in the business cycle. First is expansion, where employment is strong, consumer spending increases, corporate profits grow, and risk-taking ramps up. Then comes the peak, where the economy is operating at elevated levels. Here, growth appears to be the strongest. Inflationary pressures begin to rise, and investor complacency builds. This is followed by the contraction phase, where spending slows, profits decline, layoffs increase, and markets shift into a risk-off environment. Last comes the trough, which represents the lowest point in the cycle. Here, economic data looks the weakest. Sentiment is extremely pessimistic, and this phase often coincides with economic recessions. At its core, the business cycle is driven by human behavior. Spending and risk-taking tend to push too far during expansions, while deleveraging becomes overly aggressive during downturns. This dynamic is what causes the economy to evolve in cycles, rather than progress in a straight line. One of the clearest ways to track this cycle is through something called the ISM Manufacturing PMI. This is a monthly survey that measures whether manufacturing activity in the US economy is expanding or contracting. A reading above 50 is associated with expansion, below 50 points to contraction, and around 50 suggests the economy is in a neutral state. Historically, the PMI has followed a 4-year cycle, which closely aligns with the same timeline that Bitcoin has typically followed. If this timeline remains intact, it suggests the business cycle may be in a contractionary phase until the end of 2026. This could be a very challenging backdrop for Bitcoin. After all, when we put Bitcoin's price on top, we can see a close relationship between the two lines, meaning when the PMI accelerates, Bitcoin tends to see some of its strongest rallies. And the opposite happens when the PMI falls below 50, indicating an economic contraction. So where Bitcoin goes next essentially depends on where the PMI goes next. And at first glance, the 4-year cycle for the PMI might suggest that it's likely to head down. But to assess how likely that outcome really is, we need to examine the most important force driving the business cycle itself, which ultimately determines how long each cycle lasts. That's where this next chart comes in, which shows how much money is actively flowing through the US financial system. When this line is moving higher, it tells us more money is becoming available in the economy, and when it moves lower, it signals that liquidity is being withdrawn. If we overlay the PMI, we can see a clear relationship between the two. When US liquidity rises, the PMI typically accelerates, and when liquidity is declining, the PMI tends to move into contraction as economic activity slows. This relationship also makes intuitive sense. Easy money and loose credit conditions encourage borrowing, investment, and expansion, which pushes the PMI higher, and when liquidity and credit tighten, those same activities slow down, leading to weaker PMI readings. This cause and effect relationship sits at the core of Austrian economic theory, which argues that changes in money and credit are what drive economic booms and busts. Since 2023, the US liquidity index has largely moved sideways, which helps explain why the PMI has remained around neutral levels. But the direction of US liquidity from here will play a decisive role in determining where PMI goes next. So let's take a look at the three key components that make up this US liquidity index to help us anticipate its likely direction. The first component is the Federal Reserve's balance sheet. This reflects how much liquidity the U.S. central bank has added into the financial system through asset purchases. After peaking at roughly $9 trillion in June of 2022, the Fed allowed about $2.4 trillion of assets to roll off its balance sheet. This process, known as quantitative tightening, steadily removed liquidity from the U.S. system. But this month onwards, that tightening has officially ended. Instead, the Fed has announced it will begin purchasing $40 billion of short-term Treasury bills going forward. This is what the Fed is calling reserve management purchases, rather than quantitative easing, but it will still increase bank reserves and expand the Fed's balance sheet, similar to what we saw during the liquidity operations in mid-2019. As a result, the Fed's balance sheet is now shifting from a headwind to a tailwind for the U.S. liquidity index. The second component is the Treasury General Account, often referred to as the TGA. This is essentially the U.S. government's checking account at the Federal Reserve. When this line is falling, it means the government is spending more than it is borrowing. This is when money leaves the Treasury account and enters the economy, directly adding liquidity to the system. When this line is rising instead, the government is borrowing more than it is spending in order to rebuild its cash balance. That process pulls reserves out of the banking system, leaving banks with relatively less money to lend. In effect, rebuilding TGA acts as a liquidity drain. Back in July of 2025, the Treasury announced plans to rebuild this account to $850 billion by September 2025. By November, the balance had already exceeded $950 billion. This overshoot largely reflected the government shutdown from October to mid-November. During that period, borrowing continued while government spending was delayed, causing cash to accumulate in the Treasury account. Since the government reopened, though, the TGA has begun moving lower after reaching its replenishment target. From here, this account is likely to either remain range-bound or continue declining, depending on the balance between government spending and new debt issuance. But the key point here is that there is no further liquidity pressure expected from the TGA component. The third component is something called the Reverse Repo Facility, or RRP for short. In simple terms, this is just a parking lot for excess cash in the financial system. When there is excess cash and not enough attractive short-term options to earn a return, that money is parked in the RRP instead of circulating through other parts of the market. That's exactly what we saw after the 2020 pandemic, when the system was flooded with liquidity and the RRP balance eventually rose to $2.5 trillion. But when better options exist, that cash leaves the parking lot, like we've seen from 2023 onwards. Right now, the RRP is almost empty, which is actually the normal state for this facility. This would only start rising again if cash suddenly had nowhere else to go. That could happen if the Treasury sharply cuts back on short-term bill issuance, if the Fed cuts rates aggressively enough that short-term cash yields fall below the RRP rate, or if a financial shock pushes investors into safety. At the moment, none of those conditions are in place, so today there is no large pool of sidelined cash waiting to re-enter the system, meaning the reverse repo facility is unlikely to become a big drag or boost to U.S. liquidity from here. Now, to calculate this U.S. liquidity index, we take the Federal Reserve's balance sheet and subtract the Treasury General Account and reverse repo balances. We already know the Fed's balance sheet is set to begin moving higher from here. The Treasury General Account is likely to remain stable or continue declining, and the reverse repo facility is already drained and expected to stay that way. Taken together, this strongly suggests that the U.S. liquidity index is set to move higher from here. And if liquidity does begin to rise, it becomes reasonable to conclude that the traditional 4-year PMI cycle may extend this time, which would also imply that Bitcoin's typical 4-year cycle is likely to be extended as well. This does not mean that Bitcoin is about to skyrocket straight to new all-time highs from here. When we add some key moving averages on top, we see that Bitcoin has broken below them, with all three beginning to curl down, until price is able to reclaim these moving averages like it did here. here, and here. Short-term pressure remains to the downside, but we do not expect Bitcoin to experience a typical 75% bear market lasting until late 2026, based on the business cycle and US liquidity conditions. We exited all of our crypto positions in early October as Bitcoin began losing its bullish momentum, and have remained patiently on the sidelines since. This is one of the most important skills to develop as a trader. The next key region we're watching is $105,000 to $108,000. A decisive reclaim of this area would suggest that momentum is once again turning back in Bitcoin's favor. We've been taking our clients step by step through this macro environment, outlining our exact crypto trading strategy through 3 premium videos every week. We send out buy and sell alerts whenever we make any changes to our position. You can see all of our closed trades for 2025 and 2024 on our homepage for free using the link in the description below.